Now we're going to cover compliance and procedure. I didn't cover this in great detail because a lot of the stuff you can just read in your textbook and there's not a lot to understand. It's just something that you need to know, but that doesn't mean it's not important. The first thing we're going to cover are estimated tax payments. Every corporation has to pay 4 installments of estimated taxes equal to 25% of its required annual payment. And in fact, this isn't just a corporate liability. Individuals have to do this too, but most individuals receive a salary and therefore their taxes are withheld, so they're making more than quarterly payments. They're making payments every time they receive a paycheck. But if they're self employed, then they would also have to make these estimated quarterly payments. For all but large corporations, the payment is the smaller of all of the tax shown on the return for the current year or all the tax shown on the return for the preceding year. If your income is going up, your safe harbor is that you divide last year's total taxable income by 4 and pay tax on that amount. If you're a large corporation, though, that's one whose taxable income was $1 million or more in any of its 3 immediately preceding tax years, you're not allowed to use that prior year safe harbor. You have to use this year. You can base your first tax payment on the prior year's liability, but after that, you have to use this year's earnings. Every corporation files a return even if they have no taxable income to report. If a corporation's in existence for only part of the year, it files what we call a short period return for the partial year. The normal tax return filed for a corporation is Form 1120, and corporate returns must be filed by the 15th day of the 4th month following the close of the corporation's tax year. So if it's a 12/31 year end, then they have to file their return by April 15th. If it's a June 30 year end, they have to file their return by September 15th. Form 1120 is going to require a balance sheet showing the financial accounting results for the beginning and end of the tax year. That'll be on Schedule L of Form 1120. And then Schedules M1 or M3, and these are similar schedules. M3 is for a large corporation and it goes into more detail. But these schedules are going to require a reconciliation of book income and taxable income. As you've probably figured out, income for tax purposes and income for book purposes is different. There are temporary and permanent differences. You can look on page 3-34 for that discussion. But generally, there are some tax items that we recognize before we recognize them for book, some that we recognize after, and some that we never recognize for one or the other. So temporary or permanent differences. Form 1120 also requires an analysis of the unappropriated retained earnings account on Schedule M2. Book tax differences have implications not only for preparing the reconciliation schedules. M1 and M3 also affect how the financial statements present income taxes. So income tax expense usually breaks down into a current component and a deferred component. The current ties into the tax payable for the year, and the deferred is going to arise from book tax temporary differences. So this would create either a deferred tax asset or a deferred tax liability on the balance sheet. The income tax expense also can contain a state tax component, which is not in this course, but it is important for corporations. GAAP established ASC 740, and it establishes the principles of accounting for current income taxes and deferred taxes arising from temporary differences. This is a GAAP requirement, so this is something that you will encounter more in a financial type accounting class. So I'm going to cover it fairly quickly, and it's not as important for our class. So we're just doing an overview here, and you'll learn more about it later. ASC 740 set out 2 objectives: to recognize current year taxes payable or refundable, and to recognize deferred tax liabilities and assets for the future tax consequences of events recognized in a firm's financial statement or tax return. To do that, they applied the following principles. They want to recognize a current tax liability or asset for taxes payable or refundable on current year tax returns. They want companies to recognize a deferred tax liability or asset for future tax effects attributable to temporary differences and carryforwards. They want to measure current and deferred tax liabilities and assets using only enacted tax law, not anticipated future changes. They want to reduce deferred tax assets by the amount of tax benefits the firm does not expect to realize based on available evidence and adjusted via a valuation allowance. And they want to establish a liability for uncertain tax positions if necessary. And these are temporary differences that would require a deferred tax liability accrual on the balance sheet. So these would occur when you have revenue or gains that are recognized earlier for book purposes than for tax purposes. This might happen, of course, if you were an accrual, you prepared your books on the accrual basis of accounting, which GAAP will require, but you prepare your tax returns on a cash basis of accounting. Expenses or losses are deductible earlier for tax purposes than for book purposes. Tax basis of an asset is less than its book basis. Tax basis of a liability exceeds its book basis. So these would be deferred tax liabilities. The next section would be temporary differences and deferred tax assets. That would happen when you have revenue or gains that are recognized earlier for tax purposes than for book purposes. Expenses or losses are deductible earlier for book purposes than for tax purposes. The tax basis of an asset exceeds its book basis. The tax basis of a liability is less than its book basis. Operating loss or tax credit carryforwards exist. So again, this all arises because you maybe use a different method of accounting for tax and book, which is very common, or there are certain things that are recognized on one set of books and will never be recognized on the other. If you have, say you have tax-exempt interest, you don't pay tax on interest you earn on a state bond. Well, that is not obviously going to appear on your tax return because it's tax-exempt. You're not going to be taxed on it, but that will appear as revenue on your books, things like that.